Hey, Wall Street Winners, Courtney Smith here with the March 13th edition of Wall Street Winners. Well, last week I told you that I was pretty tepid on the market, and fully paid up members, we basically got out of a lot of positions. These are some of the things that I talked about last week. So keep that in mind. This is what's going on now. We're back into the bear market mode that we were in last year. Now, there's still some hesitancy there. It's not 100%, but let's go through some of these indicators. This is the big one. We had a huge monetary explosion. And look at this. This is the key part. We're declining hundreds of billions of dollars of money supply. And when money supply goes down, it's very difficult for the stock market to do very, very well. During this period, when money supply was booming, stock market went up. This period, not at all. So let's take a look at our normal indicators. This is a channel, which I'm not a big fan of channels. I'm not a big fan of trend lines. Any diagonal pattern tends to be suspect. But the point is, we broke below the trend line. We broke below this mini low. This is the critical low in my mind, the December low. Typically, when the market breaks below the December low, it's not a good year for the stock market. So the January trifecta of the Santa Claus rally, the first few days, the January barometer, were all bullish. But breaking this December low completely offsets that. So this is the key point we have to look at now. So right now, I've set up the scenario where the fundamentals are starting to turn very bearish. I talked about that last week. A break of this December low would be awful. Now, one of the things I've been talking about for some time has been the purple predictor. This is on balance volume, and it tells you what the smart money is doing, and they've been selling since December. Let's take a look. Now, having said that, we also have a situation where the market has probably gone too far too fast. We might get a couple more down days. Tuesday is CPI. That's going to be a huge release this week because, of course, it'll help define what the market thinks the Fed is going to do. So here we have now, let's take a look in the upper right-hand corner. You can see that all of a sudden this little red line shows that selling pressure skyrocketed. Buying pressure went down, but not too low, but the selling pressure skyrocketed. Now let's take a look. Here's the previous times we got there. Just a few days before a major rally, a few days before a minor rally. This one didn't work. This one, major rally. Another bullish factor. Over here, you can see the RSI has gotten down to the 30 level. So I think we'll see a little bit of follow through from Friday's terrible action, and then we'll probably see a sharp rally on some of these oversold conditions. Now, we have to watch that very closely because when a market becomes oversold, most of the time, it will rally after that. The worst bear markets is when it doesn't, okay? And where it just collapses, okay? The crash of 87, et cetera, et cetera. So we need to watch it very closely. But under normal circumstances, and I don't think we're in a disaster situation yet, we will see a rally coming up maybe late this week. I put out a video on YouTube that I want you to go watch on my YouTube channel where I talk about the banking crisis going into a financial crisis because of two banks dying this last week. Okay, over here in the NASDAQ, once again, purple predictor not looking good here at all. We're not down to the 30 level on the RSI, but we're getting there. We'll be there in a couple of days. Seasonality, though, has been the major thing that has been bullish. And we're still on a buy signal. We'll get out. If it breaks, guess what? December's low. Now, the other thing that was interesting about this chart was, first of all, the smart money was buying IWM, small cap stocks. But look at what happened. They were hit even harder than the large cap indexes that I've just been showing you, largely because of small regional banks. Wait a minute, small regional banks going belly up? Shades of 2008. Well, we're not there, and we're not going to have a consumer-led debt crisis like we did in 2008. The next one, as I've been telling you, will be corporations and the government. They are much more in debt. Now, seasonality, this is the big bullish thing. Clearly bullish. There's just no question about it. So that tempers my bearishness because we have to take all the factors. I go through each one of them. You'll notice each week I go through each one of them as if no other factor exists. And then at the end, we combine them all. Okay, look at this. Asset allocation. They bailed out of stocks and went into bonds. And it was those people that really crushed the market. And risk. We've been going down on risk for a while. We've talked about it, really moving into consumer staples, utilities, but even consumer staples and utilities got hit. So this is not down super sharply, not like, say, back over here in May of last year. That was a very sharp move, but we've been consistently going towards more risk and away from the sexy stocks. We also saw Europe got hit, but it'll be hit more on Monday because a lot of the U.S. drop occurred while Europe was asleep or their markets were closed. So look for them to drop sharply on Monday in a catch-up effect. Yield curve was moving slowly positive. Whammarama, back more negorama. Now, this is not good. This is not good. Having the yield curve this negative means that banks, which were hit very, very hard on Friday, banks are not going to make any money. And they're not going to lend money. And they're going to tighten their credit standards. And all of those things shrinks the economy. And so the Fed's going to have to ease pretty soon. Now, I'm going to do more research on that, and I'll come up with something. So be sure to go to CourtneySmithBlog.com for updates on my thinking. CourtneySmithBlog.com. Check it out. Bonds sharply higher on a flight to quality. You can see there was a little bit of buying by the smart money and then a lot of buying on Friday. Heavy volume here as well. So look for bonds to continue up to this old resistance here. Not a major bull market unless we have a crash in the market, in which case then all bets are off. Bond key factors, we talked about that last week. Here you can see, here's U.S. yields. That's a green line. They came down. Once again, European yields, this is German yields. They weren't even open when the crack occurred. So they'll start to come down here as well. I'm going to show you gold in a second, so we'll talk about that in a second. A dollar, because bonds were up, yields were down, therefore dollar down. Now that's a reversal of what I thought last week. Gold popping up, once again, a reversal from what I was thinking last week. But short-term interest rates and long-term interest rates are the key to the gold market right now. Real interest rates are the key. That's why inflation is important, because it's not inflation that people buy gold for. It's inflation combined with interest rates, i.e. real interest rates. But the buying was strong and it was on heavy volume. So this looks like a good rally here. Not a long-term one, but a good one. Now, our indicators. Let's take a look at our top indicator here, which is the euro, drifting lower. But I counted it as neutral because over the last several weeks it's been sideways. But here the CRB is going down. That's bearish. So I put it as bearish. And then here the yen started to perk up a little bit and I rated it as neutral. So this is a step slightly better, but it's still not telling us we should be getting into a big bull market. We shouldn't be getting long gold, but we shouldn't be short gold. Crude oil rallied on Friday, which I find very interesting. I guess it's based on the lower interest rates that we saw because it's definitely not on higher demand. But look at the purple predictor. It's breaking to new highs multi-month. In fact, what is this? This is the highest since October. So the smart money's buying oil. Now, I put out a video once again on my YouTube channel a week or so ago about the bull case for maybe a week and a half ago on. So go to the YouTube channel, check that out. I'm bullish on this, but if we go into a bad recession, I think what the market's saying is if we go into a bad recession at the beginning or even before we get into it, we're going to see the Fed ease, and that will help out commodity prices. Bitcoin is collapsing. Largely, one of the banks that went belly up was Silvergate, which was a crypto bank. They went belly up. A second problem was the big bank. Silvergate's a small bank. But this other bank was Silicon Valley Bank, which is the 16th largest bank in the United States. And guess what? Lots of Bitcoin, lots of crypto businesses had their money there. They don't have the money anymore. Circle, no money. It was in Silicon Valley Bank. And of course, there's no insurance for corporations who have over $250,000 in the account. So see you later. Take a look. We've been talking about this for several weeks. Failure. Make higher highs on the price, make lower highs on the purple predictor. This is very bearish. I was early saying we're going to 13,000, but I think we're now on the way to 13,000 as so much cash we don't even know the full ramifications of the collapse of Silicon Valley Bank, because so many crypto companies had their money there, as well as many other tech companies like Etsy, Roku, hundreds of companies. I don't know if it's thousands, but hundreds of companies for sure aren't going to be making their payroll because their money was in Silicon Valley Bank. So this is going to have a lot of reverberations, which we'll start to find out more and more on Monday. This is a big story. All right, everybody. I'm much, much more bearish. Our fully paid up members, I'll be there in a second, but you just have to be hiding out in bonds, treasury bills. You want to be taking no risk at all this week, because the collapse of these two banks will have knock-on effects that we don't know what they are yet. So we need to just relax for a week. Take it easy, not have a big portfolio, maybe have a few stocks, but basically it's a time to be conservative. Maybe it's time for a vacation even. Take some of the money we made for you last year and go on a nice vacation. All right, freebies, we'll talk to you later. Hey, freebies, you know we love having you here every week watching the free edition of Wall Street Winners. But let me give you a little bit of a pitch of why you should actually upgrade and get the fully paid up member version. The big difference between them are two big differences between the freebie and the fully paid up version. Number one, the fully paid up version has more extensive analysis, which means that the prognostications are more accurate. And you get greater insights into what is actually happening in the market and why it's going to happen. But we're also talking about the dollar. We're talking about the bond market, the crypto market. But of course, we focus on the stock market. So better, greater, more analysis so you understand what's really going on and how reality is creating profits and how we're going to create profits in the market. Number two, and this is most important, there's actual trade recommendations. So in the freebie section, I say, well, I'm bullish on the dollar, or I think we're going to have a dip in the market and then an explosion to the upside, whatever I'm saying. You want to be able to see what I'm actually doing in the real world. So I put out specific recommendations. Now, these recommendations are actionable. They tell you exactly what the stock is. They tell you exactly the price to enter, and I tell you exactly the price to exit. So there's no doubt you can take action and you can make money. We're pushing 3 decades of publishing Wall Street Winners, and every year has been a winning year. I don't care if it's a bull market. I don't care if it's a bear market. My job, because I am a professional investor, and I do the same trades that I recommend to you, by the way. I'm putting the same orders in. So you and we're going to see the same profits. But here's the point. As a pro trader, my job is to make money trading every day. Every day. I wish I could make it every day. Every year, okay? every month because I need to know I want to buy steak. I don't want to eat oatmeal. You got it? All right. The difference between Wall Street Winners and all the other newsletters out there are number one, I'm a professional trader. They often are amateurs. Number two, I ran the top performing global macro hedge fund in the world. How many of them have ever run a hedge fund, let alone a top performing one? Hulbert rated this newsletter, Wall Street Winners, as the best performing newsletter ever. Number three, I also manage the number one growth mutual fund in the United States. Quick, how many newsletter writers have ever managed a mutual fund, let alone a high performing one? So what you're getting is my 50 years of experience at picking stocks and making money. That's why you should subscribe. This is a newsletter that doesn't cost you anything. Yes, you have to pay money every month, but the profits from the trades should more than cover the cost of the subscription. So this is a free newsletter if you take action using the trades that I put in here. Anyway, I hope to see you upgrade and become not just a freebie member. You know we love you, but we'd love to even have you come as a fully paid up member and get even more value than you're getting now. All you have to do is go to WSW2021.com. That's WSW2021.com. Sign up. Let's get going. I want to share greater analysis and great trades with you. We'll talk to you later. Thanks very much, freebies. You know we love you.